We are live. Welcome back to Two Stupid Guys Trade Stocks. I'm Vinny.
I'm Dylan.
And today we're going to talk about something near and dear to our hearts, why it is that we feel that you need to invest in order to get ahead in this world.
Yeah, make that money.
Yeah, exactly. So, put together a little presentation for you guys here about the power of compound interest. The analogy that kind of plays through here is Warren Buffett talks about how life is all about finding like a nice hill with a bunch of wet snow on it and just making that ball get bigger and bigger. That's the idea, is that the more snow, i.e. money, you have working for you, the more money you can accumulate. So
did he really say that?
That's why his biography is called Snowball.
Oh, because Dave Ramsey has the snowball effect for paying down debt. I didn't know.
Yeah.
No, that's kind of funny.
Yeah.
Right.
It is kind of funny. This is the dream, right? This is where we're all trying to get to, trying to be able to like hang out wherever we want to be and just kind of sit back and enjoy life, because we're only here for a certain number of years, and we have to make the most of those. So, important money management skills are, I think, a way we help achieve that. It's been said that you either work for your money or you make your money work for you. And that's what the stock market helps you do. It's a very easy access vehicle that lets you put that money to work and get it earning for you.
Yes, sir.
Yeah, exactly. Right. Dylan and I may disagree about a lot of things, but we both agree about the power of compound interest.
Yes.
Yeah.
Definitely.
So, just kind of a little generic ballpark about like rates of return and that sort of thing. Your average kind of savings account these days is paying about 0.05%, pretty much nothing. Those high interest online yields, checking accounts, savings accounts can get you a little bit closer to 1%, but still that pales in comparison to the S&P 500's historical average since 1957, when they first included 500 companies, of 8% per year. It's actually even a little higher than that if you go back to the post-World War II period. It adds up quite a bit over time. The simple kind of thought process is, if you put $100 in the market, next year you'll have $108 that go back in the market, and it grows faster and faster from there. You may think
$8.
Yeah, exactly. Right.
Nice.
That's $8 more than you had. But you may think that you have to like make these huge percentage gains in order to be able to become, very wealthy. But point of fact, Warren Buffett, largely regarded as the greatest investor of all time, has only had about a 17% annual return since 1985. And I say only, I mean, it seems reasonable, but it's still fantastic. Dylan and I, not to brag, have beat his rate of return over the last 3 years. So maybe we do have a little something to offer.
Yeah, I mean, we're basically better than Warren Buffett, right? Right.
Yeah, exactly.
I just wanted you to say that, and now I'm going to hold that over your head.
Yeah, it's perfect. So this is a little chart I put together. It's actually there's an online compound interest calculator from investor.gov. So it's one of the rare things that the U.S. government actually, gives us that's useful in our lives. Way
to pick a point of view, by the way.
I know, right? It actually will allow you to calculate like the future earnings of your interest earned as it compounds over years. If you kind of see the red line there, that's what compounding interest looks like compared to your contributions, which is that teal colored line. So although the teal colored line goes up at a steady rate, as you can see, as we kind of start to accelerate away with the red line, your interest is earning even more dollars. So I put this entire graphic here together from a statistic that I read where, the average millennial that plays lottery tickets spends about $976 per year. And this is just illustrating what that $976 per year put into a S&P 500 index fund would look like over 20 years. So you would have, better than $48,000 over a period of 20 years if you simply did that rather than playing the lottery.
And for those of you that don't know, an S&P index fund, basically you just throw it in and you don't have to touch it or do any work whatsoever.
Exactly.
It's just there. And the odds of winning the lottery are 1 in 303 million.
Exactly, for a Powerball jackpot.
Solid.
Exactly. Far more likely that you'll end up with at least $50,000 or so.
Yeah.
So, one of the things you really kind of notice with, this compounding interest effect is that it accelerates even more with time. So this is why it's really important to start young. This is the same, amount of contribution yearly, but over 30 years as opposed to 20 years. And you look at how much more money you would end up with after that period of time. So basically, it would be doubling that last year, or double, more than double over another 10 years.
Right.
So another way that you can kind of find money to invest with, this is another statistic basically where you're looking at not only eliminating lottery tickets but also eliminating soda from your life, which is, Dylan and I both work in the medical field and kind of tell you that soda is not a great thing for you.
Yeah,
It is delicious.
It's terrible. Also, like if you go to get like fast food or something because it's cheap, which I do all the time, like the sandwich at like Chick-fil-A is $5. The drink and fries make it $9. So
Exactly.
it really adds up the cost.
Yeah, exactly. But yeah, this is kind of what you'd be looking at in terms of savings, just using that simple S&P 500 index fund, not even thinking about it, just contributing every dollar you would normally spend on both either lottery tickets or soda over a period of 30 years. Now, when things really get interesting is when you look at like what the rate, what the amount would look like if the rate changes a little bit. So this is a 17% return instead of the 8% return with the same contributions. This is approximating Warren Buffett's return since 1985. So this is kind of what like Dylan and I aim for, at least a 20% return a year. And you see how much more that accelerates there as the curve takes this parabolic shape here.
So, Vinny,
Yes.
on that, it was $930 in lottery tickets, and then was it like $850 in soda?
I don't remember what the amount in soda was actually per year.
I think it's $850. I'm pretty sure it's $850. So that's about, let's say, $1,800 a year. So
Yeah.
that was at $150 a month. It's $150 a month.
Yeah, exactly.
We're paying more than that on streaming services. So if you just cut out soda and lottery tickets, and if you smoke, not to get too medical, that's real expensive. You could be making bank.
Yeah, I think the combination of all three was like $2,400 a year on average for a millennial.
Oh, jeez.
Yeah, and it varied from generation to generation, but the combination of tobacco products, lottery tickets, and soda was about $2,400 a year. I'll kind of mention that here in a second, but so this is just demonstrating how much that rate of return can really affect your outcome there. And it doesn't take much, you think 8 and 17 are really not that far from each other, but when it comes to rate of return, it really matters. So this is kind of a simple idea to calculate your doubling time roughly. So they call this the rule of 72. Basically, you take your annual rate of return and you divide it by 72, and it tells you how many periods it will take for the money to double. And period, if it's an annual rate of return, it's number of years. So this kind of shows you how quickly that it accelerates in terms of the, every time you double that annual rate interest rate, you're effectively having the amount of time it takes you to double your money.
So it looks like with the S&P return, let's say 10% to make it easier, not 8%, you would double your money every 7.2 years.
Exactly. Yeah, exactly. So,
and in a money market account of 1%, it would take 70 years.
Yeah, exactly. Yeah, that's
don't use a money market account.
Yeah, that's the idea. You're paid for risk. You need to kind of learn your own risk tolerance. Don't go putting 100% of your portfolio into a weekly options trade on something crazy.
Well, but you never know.
Yeah, exactly. But you do have to take risk, otherwise you're falling behind when you think about the inflationary costs. So a certain amount of risk is absolutely necessary to maintain your standard of living, and certainly to increase your standard of living.
Right. Okay.
So this is kind of another example where this is what like a Roth IRA, special kind of IRA. Dylan and I will do a video about like Roth versus traditional IRA. But if you were to max out your contributions, which is $6,000 per year currently, over 30 years, you'd be sitting on something around $750,000 in tax-free money for retirement at just simply the S&P 500 index fund rate of return, which is at 8%. So it's
that's just 8%.
This is certainly a much more sure way to become a millionaire than any lottery ticket on earth.
Yeah,
just contributing to a retirement account and investing for a few decades. And kind of in summary here, I wanted to say that I think it's P.T. Barnum used to say, if you aim for the sun and miss, you will still end up amongst the stars. The point of this here is that you just got to get in the game, you got to put in the effort, and even if you never ultimately achieve what you were hoping for, you'll still be a lot further along than most people are.
Yeah. Bill Gates had another one of those as well. He said people drastically overestimate what they can do in 1 year and drastically underestimate what they can do in 10.
Yeah. It's a great quote.
That's pretty good. Where did you get those the graphs? What site was it?
It's investor.gov. It's in the lower corner of the image. We'll link it down in the description below. I encourage everyone to go and head over there and play around with the numbers and kind of figure out what you can shave from your monthly budget. Dylan and I are also going to do a video coming up soon about ideas of things you can either cut out of your budget or ways you can make a little bit of extra income in order to put more into the market.
Side hustles.
Exactly.
It's on investor.gov. I want to know what it would be with a 40% yearly return.
Yeah, investor.gov is the web address right down there in the lower right-hand corner of the graph. Yeah, well, like I said, we'll link the actual address in the description below.
All right. Good stuff.
All right. Well, thank you for tuning in. Tune in for ours tomorrow. We're going to have our kind of weekly picks. I have a value pick for you, and Dylan's got some swing trade options, or opportunities, I should say, not options, but
definitely not options. We're not doing options yet.
Exactly.
It's gonna be very overwhelming.
Yes.
Also, we got a presentation for people who have no idea about any of the stuff that we just said. Sometimes finance or investing can be really intimidating, just basic language where it doesn't even make sense and it's over your head. So we're going to break that down step by step actually tomorrow. So
perfect. Well, thank you for tuning in. We'll see you guys soon.
Later.